Hi, believers. This is Amit from the Wire team, and I'm here to provide our weekly bite and the road ahead in the markets. Markets ended the week on a flat note as early weakness from profit booking, persistent FII outflows, and a record low rupee levels offset the support from strong macro data and the RBI's 25 bips repo rate cut to 5.25%. While Nifty and Bank Nifty ended flat, the broader market continued to decline, with mid caps down 0.80% and small caps slipping 2%. The highlight of the week was Reserve Bank of India's decision to lower the policy repo rate. The rally in the Indian market started after the RBI's Monetary Policy Committee, headed by Governor Sanjay Malhotra, unanimously voted to reduce repo rate by 25 bips to 5.25%. The MPC also raised fiscal year 2026 GDP growth estimates to 7.3% from 6.8% earlier. It reduced CPI inflation forecast to 2% from 2.6% earlier. The MPC noted that headline inflation has eased significantly and is likely to be softer than the earlier projections, primarily on account of the exceptionally benign food prices. To put in context this year, the RBI lowered the repo rate by a cumulative 125 bips in 4 meetings beginning in February. The RBI governor characterized this economic landscape as an uncommon Goldilocks phase, marked by impressive 8% GDP growth and subdued inflation at 2.2% during the year's first half. This move is supported by solid domestic factors, including sustained rural spending, gradual urban demand rebound, and vigorous government-led investment. It is a very positive situation for the Indian economy. We believe this rate cut is designed to sustain this favorable momentum by easing borrowing costs in tandem with easing inflation pressures. Sectors sensitive to interest rates like banking, non-banking financial companies, NBFCs, automobiles, and real estate, which are poised for positive gains. This rate cut also acts as a strong signal of policy support for the real estate sector and the broader economy. However, for the intended benefits to materialize, the transmission of the reduced rates must also be faster, ultimately benefiting the real estate sector and contributing positively to overall economic expansion. The RBI also revised its FY26 GDP growth estimates to 7.3% from 6.8% previously, with Q3 FY26 estimates increased to 7% from 6.4%. Q4 FY26 estimates raised to 6.5% from 6.2%. Looking ahead, domestic factors such as healthy agricultural prospects, continued impact of GST rationalization, benign inflation, healthy balance sheets of corporates and financial institutions, and solid monetary and financial conditions should continue to support economic activity. India and Russia signed several key agreements, including trade, energy, and technology during Russian President Putin's India visit, that are expected to have a significant medium to long-term impact on the Indian economy. The net effect for now is constructive for select themes like defense, infrastructure, energy, and critical minerals. The major event next week will be the US Fed meet, where the markets expect the Fed to cut rates by 25 bips. Let's move to technical levels now. The index extended consolidation in the vicinity of all-time high over third consecutive week, and broader markets notably lagged. Sectorally, beaten down IT stocks roared back by gaining 3%, coupled with traction in auto and metal stocks. A decisive breakout above 26,300 could restart the rally and set the stage for 26,800 in the coming weeks. The lack of follow-through strength above 26,300 would result in prolonged consolidation in the 26,300 to 25,700 range amid elevated volatility ahead of upcoming Fed policy and CPI numbers. Hence, dips should be utilized to accumulate quality stocks as key support is placed at 25,700, which is also 50 days moving average. We believe investors should maintain a balanced approach with a preference for large caps and sectors poised to benefit from the rate cut, particularly financials, autos, and domestic cyclicals. Export-oriented and IT names may continue to find support from the weaker rupee. Caution is advisable in rupee-sensitive and import-heavy pockets until currency volatility stabilizes. Traders can continue with a buy on dips around the key supports, with a strategy focused on stock-specific opportunities while keeping position sizes moderate ahead of the key Fed meeting. Concluding, the RBI's decision to cut rates, along with a potential rate cut in the US the following week, could spark a temporary rebound in the market, contributing to what analysts refer to as a Santa Claus rally. Historically, December has been one of the best months for markets over the last 20 years. It has ended on a positive note 14 times out of 20, with an average gain of 2%. This time also large caps have mainly held our markets well, while the mid and small caps have been beaten down badly. Nearly two-thirds of the top 750 stocks by market capitalization are still trading below their September 2024 highs. So one can expect the rally in large caps to sustain in December, but it would be interesting to watch out if the mid and small cap stocks can participate, as results have been decent. However, foreign liquidity outflow has been pressuring stock prices. Your portfolio may be red, but this is the time to show patience, so please hold on till the tide passes. That's all for today. Wishing you a profitable trading week ahead. Thank you.